Okay, let's continue. During our last class, we talked about directional bias and we used multi-time frame analysis to determine where to buy and sell the market from. If you remember, when we had last class, BTC was around this zone. It's around this zone. It's currently around this zone. We talked about directional bias. I said directional bias is you finding the right path where market really wants to go, may likely wants to go. And the patterns that market used to make is what is going to help you to determine where market is actually going. And those patterns are market structures. I said market structure is very crucial, even when it comes to knowing your direction. It's not always about liquidity or point of interest. Sometimes knowing the overall bias is one of the most crucial things. And then I said BTC, we're bullish on BTC, but it's just like we're not just going to be looking for buys on BTC. There are zones that we expect markets to retrace back. Those zones are lower time frame zones because our bias, we use higher time frame bias. We go to daily time frame to look for exact structure of the market. Let me change this. Let me use Owanda. We said based on what we can see, currently BTC is super bearish because even the daily time frame giving us structure shift, breaking structure the downside. This is a sign of what? Trend continuation. Based on this, we know that anytime we have impulsive move that breaks structures, we tend to have correction move. That's how market move. After an impulsive move, correction move should come. Another impulsive move, a correction move should form. But where do we expect those correction move and impulsive move? I say is from that higher time frame POIs that market has not used when it was buying. I gave an example. I said when market is trending off, sometimes market don't get time to come to an order block. It use breaker block to keep buying again. That's one of the model I trades. Most of my trades, especially continuation trades, I use breaker block. So this order block that market has not used when it was buying, this order block the market has not used when it was buying. So the moment market started selling down, these zones are the one we expect correction moves to come from. We'll not be expecting correction moves to come from any random zones. So after breaking structure to the downside, we know that if we go to the higher time frame, the previous price action, there are zones that market has not used when it was buying up. Example, this order block. Market has not used this order block when it was buying. Market has not used the order block. So after we have this impulsive move that break this structure, that broke this lower low that we had. That means we'll be looking for what zones that we expect correction moves to come from. We are going to mark the previous zones that market has not used when it was buying up. There's another order block right here. Those are what we're going to set our eyes on. It doesn't matter which time frame. Those two zones are what we want to set our eye on because we'll not be expecting correction move to come after just because market broke this structure to the downside, broke this low. At the middle of this nowhere, we don't expect those correction moves to come from. Market might retrace because it just take out liquidity. Market might retrace back because of what? Market take external liquidity. So market might tend to retrace back, but you should not be expecting as a correction move. Just as it did here. You see, after this low got taken out, market pulled back a bit because this is a daily time frame. So it's a kind of good move in the 4 hour and 1 day, 2 hours time frame. Pull up a bit because it just took out major liquidity and continue selling down. So this pull up the market corrects, it's not like we're going to determine it as okay, this is where we expect a correctional move from the higher time frame. So in lower time frame, that means we're bullish. No, because it's come from random zones. This zone is nowhere. After taking this liquidity, these two major liquidity, market just trace back a bit and continue selling down. These are the zones. These are the two zones that we're going to set our eyes on. These are the zones that we expect. These two zones. These are the zones that when we see reaction at these zones, okay, we can say that, okay, this is where we expect what correction move to come. And where is this falsing move going to likely come? So when we have reaction at this zone, or this zone, what are those reactions? Our reversal concept. We talked about that when we in market structure. Reversal concept is market structure shift. We want to see market structure shift at these zones. If we do not, that means it's not reversal concept, so we're not going to take trades. We want to go into the lower one. Look for possible zones because we're not, as a trader, our job is not to tell the market or to predict the market. Our job is to react. We're not just going to look out for buys here because, okay, this is just after breakup structure, this is an order block, we're looking for correction move. This is not our job. Our job is market to tell us what it really wants to do at that zone. And then we take the buy, we follow the market instincts. This is what we're going to do. This is how to be a trader. This is trading. You're not the one controlling the market. Institutions are the one controlling the markets. Your $10,000 or $2,000, that cannot move gold a bit, even if you use higher leverage, even if you use 1 to 1,000, cannot like move gold even in 1 second candle. You cannot change even 1 second candle. You cannot do that. Even milliseconds candles, because those people are trading with billions of dollars, trillions of dollars. So that means you're nothing. You're like a fish in an ocean. So what we're going to do is our job is for this small money, because they cannot hide their blueprints anytime they want to enter a market. So when a market approaches those two zones, so we go to time frame, lower time frame, to look for the reaction at these zones. Are this smart money wants to start buying from there? No. That means there's no market structure shift. So we're not going to look for buys. Instead, we're going to look for sales if we will have structure for sales all the way to this next zone. When market approaches this next zone, we're going to ask ourselves question. Is smart money ready to buy from this zone? No, yes. Why do we say no? Because there's no structure shift. Okay, then we look for another structure down below. But if I really want to buy it, then we are going to have a structure shift. And structure shift is one of the reasons we use to take a continuation reversal concept. After we go multiple structure, confirming the current direction. So a structure shift in markets taking out the low, this low, and then give us a structure shift, and then we look for what? Forcible reversal concept. And that zone that we expect this correction move to come from must be a high time frame POIs. Those two POIs that are marked. Any zone that this correction come from that are not high time frame POIs, we don't consider it a market structure shift. Market will use that same zone because you have structure shift, you have breakup structure right here, and then a liquidity. Market might use this breakup block and continue selling down, take you out and continue selling down. Market can decide to use something like this because this zone is very important when we come to marking our structural shift, MSS. This zone is very much important where the buy is coming from. So you see, if we have a buy at any random zone, we're not going to consider it as a market structural shift. We're going to consider it as okay, market used to want to grab some liquidity to continue pushing down. So it can give you you can say, okay, this is a structural shift, but actually it's a liquidity sweep. It swept this low and then tapped into any POI, this breaker block or this other block right here and continue selling down. So our job is to react to those market movement. Is it the market structure shift? No. Why? Because it's not coming from a high time frame POI, which is order block or breaker block. It's not coming from any of the zone. Okay, that means market just want to buy a bit to tap into any demand zone, supply zone up here to continue selling down. So excuse me, sorry. Okay, sorry, let's continue. I said it's very important to know where this buy is coming from. The buy that is going to create the market structure shift. If it's not coming from high time frame order block or breaker block, we're not going to consider it as high time frame. The same thing in lower time frame. Structures happen first in lower time frame before in high time frame. For example, if we have markets trending down, selling down, right? Let's say this is a daily time frame. Before we confirm that market wants to structure, want to shift direction in daily time frame, we want to see markets take out this high first. And for us to be looking for buys now, we have to wait for markets to take out this high. So that means if you're a swing trader or someone that doesn't know how market make a move, after impulsive move, this correction move, you have to wait for market to take out this high first in daily time frame, which is going to take about month or 2 months. Then market give you liquidity, and then you should be looking for sales. So I mean, for you to take a buy, you have to wait for like 5 or 4 months just to take a buy. But if you know that anytime market has impulsive move, correction move has to come. So that means you're just going to mark likely zones that you expect what markets to give you those structural shifts, those previous price action. And then when market taps into these zones, then you look for structural shift, and that structural shift is what you're going to use to buy. And you will keep buying until market tell you otherwise. So this is how you can determine your directional bias. It's not something that's very hard to find. You just have to understand market structure. The same thing when we have this structure, we know that okay, for higher time frame, this is currently a what? We're in a correction phase. So anytime any moment, we're going to have another enforcing. Sorry. I said anytime you have a correction move, you mark the zones that you expect the correction move to happen. When market give you structural shifts, then you take a buy. We don't have to go back to that structural shift because we were in this class on this topic for about 3 weeks now. So you look for structural shifts. And you know that I said structural shift happened first in lower time frame before in higher time frame. Let's say this is a 4-hour time frame. Excuse me, sorry. Yeah, sorry, I'm back. I said if you have a higher time frame structure, market structure shift happening in lower time frame before it happens in higher time frame. So based on this example, if this is a 4-hour structure, before you look for high 4 hours market structure shift, you will see that in lower time frame, let's say 15 minutes. Because if this is a 4-hour structure, when you go to lower time frame, you not see something like this. You see something like this. Market give you higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Then market give you structural shifts. Wa alaikum salam. Okay, after this, you see lower time frame, you already have structural shift because what this buy is going from this order block right here. So before you see that 4-hour structural shift, you must have seen it in lower time frame. And then from there, you're bullish in that lower time frame. But keeping in mind you're bearish in 4-hour time frame. That's the same thing in higher time frame. You see, when we have this correction move coming from this zone, because we have a market structure shift, then we marked a zones that we expect markets to what fall into before another enforcing move to come from. as soon as we have structural shift at this zone, the next thing we want to do is to go to higher time frame to mark zones that are very likely market will use them to sell, to continue selling down. Those zones can be our targets. If you're a swing trader, those are the zones you target. If you're a day trader, those are the zones that you target. Same thing if you're a scalper. Those zones, you'll be buying until those zones go tapped. So I said, after you go structural shift at any of these random zones, then you marked a higher time frame POI that original trend, overall trend must likely continue. Those zones can be a higher time frame order block or breaker blocks. So based on what you can see, we have an order block here. The market used it to did a correction move and then invalidate this breaker block. We have this initial order block right here. This supply zone. There's another extreme supply zone up here. So all those zones are what you're going to wait for markets to pull in. So your job is not just to predict. I'm not just be looking for sales here, set my sell limit and sell from there. I'm not the one controlling markets. So good trader is the one that reacts to markets. Not just tell the market, you know that overall, you know where market's likely going to come. Just because you hit stop loss, you try to sell and you hit stop loss, that does not mean you're bullish now. You must You must know that your high time frame structure is telling you things. It's telling you that, okay, market is currently bearish. So even if lower time frame look bullish, your targets, you're going to look for those zones. You are going to watch out for these zones, because those are most likely zones for markets to pull into before you have another impulsive move. The same thing after you go, anytime you go a low got taken out, higher time frame low, like this one now. You see, market give you another structural shift right here. Market give you another structural shift right here. Then you look for zones that you expect markets to fall into before you look for the correction move to come from. Because we say correction move should not come from any random zones, right? So these zones are higher time frame, most likely POI. A breaker block, an order block, or a breaker block. All of those high time frame POIs are the one you're going to look for, because market might fall into those zones before you look for another correctional move to come from. Then you mark this zone as a trader. You mark all of those zones and wait for market's reaction at any of those zones. Do you guys understand?
Yes, we understand, but me, when I mark the zone, it doesn't react like onto the zone when I go to the lower time frame. It seems as if I just have like to restart back. And when I restart back, it's not still giving. That is my actual problem now.
Okay, if it didn't give you, then you stick to your high time frame POIs.
But they'll make month, because I know that if I go to the lower time frame, I have to like wait for a market structure shift or a change of character or a liquidity to be swept.
Yes.
For the process to continue, right?
Yes.
But they will just come and kick me out. I don't know what my error is. I don't know if the other block are not marking one. But I went again, right under the other block is correct. Went again, right under the block is correct. I even went like imbalance, so fair value gap.
Yeah. What is the question now?
That I don't know why my own is not giving. There is no question.
Is it?
There's no question. I'm just like complaining, why is it my own not giving?
Okay, let's continue, because we're not trading the higher time frame. We'll use the lower time frame just to know what market is likely targeting. Just to know where market is likely targeting, right? So all of these zones, all of those zones that we marked, we know that high time frame, super bearish, because market giving a structural shift. Now, what are we going to look for? Right here. We have to look for where this buy is coming from. If it's coming from a valid POI, so we know that, okay, it's time for markets to correct the move. And it's really coming from a what? A 4-hour order block or a daily order block. It's much more clear in the 4-hour because this is an order block. You call it a what? A mitigated zone because market use it once and market is trying to use it twice. I hope you understand what mitigation zone is or mitigation block.
Yes.
Mitigation block is a block when you have an order block that has multiple touches. Those zones that they're not likely, they're not 100% safe. I would say it's not 100% valid, but they're still valid. Because like the same thing when you have two resistance level. You see, when you have resistance level, the market touched and then touched again. You know that you have an equal high, right? An equal high is a type of liquidity that markets mostly attracted to. Anywhere price is there, even if price wants to go lower, you see those equal high. All those equal high, they're like magnet to price. They attract price. Price can come and take them out and then continue selling down because those zones are what? Because it's one of the reasons why market make a move. So that because of this zone, you see it's a mitigation zone, but because of how risky it is, because it's very magnet to price, price can come and take them out. That's why it's making them like not 100% valid. But still, if they have liquidity, market will take out this liquidity but before continue down. You see, this is the liquidity. The last low that got tapped into that zone. And market come back, take out the low, and use that same zones to buy from. So you see, this one is one of the valid zones to buy from. Please excuse me 1 minute. Okay, let's continue. You see, it's still valid. Market take out liquidity at the zone. And then if you go to lower time frame, you see structure shift. That's why we thought I taught you last class. Because we like did our most time frame analysis. After we know our high time frame analysis, then we combine the high time frame analysis towards lower time frame analysis. So at that zones, the market give us a structure shift, right? A sweep liquidity or give us structure shift. Those are the two valid what confirmation entry we use for reversals. It says that sweep the liquidity or give us structure shift. And those zones, those sweep of liquidity are coming from that POIs. So after, I think on our last class, BTC was at this zone when we did class. We said all those 4-hour zones are the zone that we expect markets to what? To trace back before going to that daily order block that we're expecting continuations to happen. And that daily order block is what? As soon as we marked our zones that we expect correction move to come, so we're going to look for high time frame to mark the zones that we expect that continuation of impulsive moves to come from. Those zones are higher time frame POIs, fail order block or a breaker block or a order block. Those zones are higher time frame POIs. If you go to daily time frame, you have this order block, you marked it. You have this also OB. Well, just because market reached to those zones, you're not bullish in high time frame. You might be bullish in lower time frame, but in high time frame, you just know that you're bearish, super bearish. Until market take out this low, this higher low, you're not bearish in higher time frame. Market can fall into all of these zones, can come to this extreme supply zone and continue selling down. You're still bearish. But in lower time frame, you're bullish. So how would you combine that lower time frame to higher time frame? That's what we're going to talk today. So I said, first of all, if you marked the zones, let me clean all this. I said, first of all, if you mark the zones that you expect markets to pull into before you expect another impulsive move to come from, those zones can be a higher time frame POIs. So you mark this zone, and then you mark this zone. So you should not be just looking for what? You should not be just looking for sales anywhere at the random zones. You have two most likely zones that you expect markets to both tap into and scale down. So you see, as your job as a trader now is what? To wait, because you have two probabilities on two probable zones that market can come into, and then they say continuous. So this is, you just go on to what? React to what market is telling you. Market give you structural shift here. Okay, it's fine. Market wants to use this zone. Then you take continuation of sell. It didn't give you, you look for your breakup structure, liquidity, and then continue buying. Multiple breakup
Right.
structure, continue buying all the way to
Yeah.
this zone. Market give you structural shift. It did not, you don't care. If it didn't give you structural shift, you take your continuation, your reversal concept, and you sell it down. And then you marked your overall higher time frame targets. What is that target? To create a new low. And this new low is right here. So this is
Mr.
what
Zach.
you said?
Yeah, Mr. Zach, I have a question.
All right.
So my question is on this higher time frame, right?
Yeah. Yes.
If we are using higher time frame key zones as the measure level key zones where we'll be
Expecting some.
expecting price to reach.
Yes.
If it gives a market structure or shift or change instead of delivery,
Yes.
then we want to take our position. Oh, so we'll be looking forward to that change in delivery. If in case it doesn't give and it continues, we are doing continuation trend.
Yes.
But we only look at it based on the fact that when we have marked the demand zones
Yes.
or the breakout
Supply.
blocks,
Yes.
when price reaches there, we are supposed to go down to the lower time frame to look for the market structure shift, right? Because I don't think we can look for market structure shift on a higher time frame.
We don't. That's why I said, if you have
Okay.
1 day time frame, your structural shift should be at 4 hour time frame. If you're looking
Okay.
for daily time 4 hour structure as your bias, your structural shift you look it at 30-minute or 1 hour time frame. So same thing if you're using monthly time frame, so your structural shift should be at daily. Do you understand? Do you understand?
Yes, I understand.
Okay, see, based on what we use 4 hour our bias. Market fall into any of these zones, we look for structural shift, and that structural shift should be from higher time frame, which is 4 hour time frame. Because lower time frame structure can be a trap. Because if this is a higher time frame structure like this, market give you higher highs and then higher lows. In lower time frame, you can see something like this. Market give you higher highs, higher lows, higher highs, higher lows. Sorry. Higher highs and higher lows, higher highs, higher lows, higher highs. Then give you structural shifts. Most traders, the one thing you have to understand is, you see, this is a 4 hour leg. For you to get that 4 hour structural shift, market should break this structure, this high. And then as soon as market tapped into this OB that you expect markets to give you that structural shift, then you have structural shift in 15 minutes. So why should your target be in that 15 minutes? You cannot be just looking for sales at this 15-minute structure and then target all the way down. That's the one of the most traders mostly do. It's a belief in that for our 15-minute or 30-minute structure. After they have they mark their complete structure in the 4 hour. That's why market will slow down, because this is an order block again. This is an order block. Market can sold again from this zone to this zone and then continue pushing up. Because this is one of the POI, because 4 hour tell you structure is bullish and then 30 minutes give you structure shift. You're still going to look for sales on that same 30-minute structure. But your target, you should what? Not target all the way to this low of this 4 hour. Because 4 hour did not give you. If market break this 4 hour, okay, it's all right. Then you look for zones that you expect continuations to happen. Market can continue selling from that 4 hour breaker and keep selling down. Market can use that 4 hour breaker to buy again. Market can come to that zone because you're still bullish in 4 hour. Market can come to that zone, tap into that 4 hour, and continue selling down. So you see how strong the 4 hour is. You have the 30-minute structure, but 4 hour structure is much more stronger. And then market use that 4 hour structure to continue buying and invalidate these 30-minute structures. So that's why if you have higher time frame, like daily time frame, look for 4 hour structure to go shift it. Same thing, if you have 4 hour structure, look for 15-minute structure or 30-minute or 1 hour structure to go shift it. That's what you should be looking for. So after we mark these zones that we expect markets to pull into to start selling, what is our next job? Our next job is to go to 4 hour time frame and look for same thing, impulsive and then correction. And those impulsive are coming from that, because we're bullish in 4 hour time frame, those impulsive are coming from that previously zones that market has not used. Then we mark those zones. We'll be buying and then we'll be marking those high time frame zones. We'll be marking these zones. Where are they? This order block. We have another order block right here. All those zones, we have another order block right here. All those zones are what is the purpose of us marking these zones? Who can answer me this question? What is the purpose of us marking these zones?
I think, I don't know if it's correct, but I think that the purpose for us to mark the zone is to like see how it's going to be reacting on the lower time frame. To see
same thing.
if
We use that higher time frame, this per hour OB, to look for correction move. Because if we read our structure in the 4 hour, we have structure shift right here, right? We have this market structure shift. We have this as our liquidity. And that buy is not coming from any high time frame POI, because this is the valid POI that we have in the what? In the 4 hour time frame for markets to continue buying. So after this liquidity, we marked our what? Our POIs and liquidity. Then what are we going to look for? We're still going to look for buys, but this we have to what? Note that this is a zone, a most likely zone, because market give us structure shift, give us liquidity, but it did not tap into the original zones that caused this two, break of structure and the liquidity. So know that market might come back and tap into the zone and continue buying, but it will choose not to. So that's why we're looking for these higher time frame POIs for markets to tap into these zones and give us structural shifts. We mark those, we'll keep buying because market is bullish. We'll keep buying in the lower time frame, but in higher time frame, this is where we're expecting to markets to pull into before we look for continuations. Same thing I explained to you just now. We have higher time frame. Before higher time frame structure completes, we have a lower time frame structure. And that lower time frame, you can look to continue selling and selling in the lower time frame until market approaches this higher time frame. Then we'll look for another buys. So that means you have impulsive move. Now you look for correction move, then another impulsive move. So you see, those zones that we marked are the zones that we expect this correction move to come from in the 4 hour. The same thing we use in the 30-minute and the daily time frame. When market tapped into this zone, we go lower time frame. If we have structure, we take the sell. And what is our target in the sell? Is for market to clear some liquidity here before pushing up. All of those zones, all of these higher time frame POIs, these 4 hour POIs, are possible zone market will use to continue buying. But our target is just to catch this correction move for markets to clear some liquidity, because even here you see you have multiple breakup structures. Let me show you. Market break this structure and then break this structure and then fall down to give you this liquidity. You see, that's the thing. I think I asked you a question about this. If you have two POIs that has all of them has liquidity, which one to choose? Because this scenario happened a lot when it comes to trading. So your job, you see, your job as a trader, you see, all of those are higher time frame POIs, your 4 hour, because you're not going to combine that. You're done with that daily time frame. Now you're looking for your higher time frame, which is your 4 hour. Daily time frame, you know what to do. You already did what needs to be done in the higher time frame, in the daily time frame. So you have no problem with that daily time frame. The only problem you have in the daily time frame is marking this zone. This zone. This is the zone that we expect markets to fall into before even another impulsive move in the higher time frame to come from. Until market approaches this zone, we don't care about lower higher time frame. Now we're going to care about lower time frame. So that's how you can use multi-sample analysis. So all these zones that you marked, you want to see market tapped into, and then give you structure shift in lower time frame. Because this is 4-hour time frame, you can look structure shift in the 15-minute time frame or 30-minute time frame, and you look for your what selves. Do you guys understand?
Yes.
Do you have questions?
No.
All right then. I think we're gonna call it a day since there's no questions. Because I don't want to complicate things. There's one thing I want to talk about, and it's kind of range, and I should not combine it with this class actually, because I think I'm going to pass, so I have to make it specific class. Since we have class on Sunday, right? Then we're going to talk
I was
about.
going to ask about range, but since we'll have a class on it, so it's fine.
Yeah, we're going to have class on that on Sunday. This is based on our timetable?
Okay.
Yeah, so that's why I don't want to. I think I'm rushing. That's why I said, okay, let me stop here because there's a lot of things to do actually. So a lot of back testing, and then this thing, you cannot just use BTC because I give you BTC on, for example, you cannot only be using BTC. You can go to other fairs, do the same thing. If you have problem, come to my DM and ask. I'm going to set a class. It's just that I'm kind of busy these 2 days, but everything is set now. I'm 100% back. So that's it. So in our next class, we're going to talk about range, how we can use range.
Okay.
You said? I want you to go and backtest because I only trade BTC and gold. That's why I'm giving you example on those. But if you trade currency pairs, if you trade other pairs, you can use those, and then you can decide, you can do that and backtest to see what's really happening in the high time frame and the 4-hour time frame. That means you combine the high time frame and the 4-hour time frame to see how they're correlating with each other. How lower time frame is helping you trade higher time frame, and how higher time frame is helping you know where market is actually going and how you can take advantage of those. So if you're a swing trader, based on those two things, market give you full into any of those zones, I'm going to give you, I don't want to give you like cheat code, but we look for structure shift at any of the zones. That's how you can use if you have two POIs that has the same zones. So we look for structure shift. If it give us, we're going to look for buys. If you're a swing trader, you're going to hold your buy all the way to that daily order block. And if you're a trader like me, then you look for what possible zones that you expect another correction move to come from. In this case, this order block. So I can take my trades to this zone, or I can use what to target all of this trade line liquidity the market has created, which is this high. I can use to target the high. So depending on the trader you are. So